Hello everybody and welcome back to the channel. For anyone new here, I'm trying to build a dividend portfolio to get enough in dividends so I can replace my active income. So my account balance is currently at $26,408 and I hold American stocks in my RRSP which pay dividends, so I don't have to pay that 15% withholding tax for American companies since I'm Canadian. And I also have a TFSA, which is worth $25,000, and this one has gone back into the green recently since stocks have performed a little bit better this week. So the main update in my RSP is that one of my holdings, which is Vici, has raised their dividend by 6.4%, which is really nice. This is a very high quality real estate company. So what sets Vici Properties apart from other REITs, and why is it performing, better relative to others, which are, down 10, 20, 30% even? And that is just going to be the type of real estate that they have. It's very experiential. So you think of casinos, they're getting into golf courses, they're getting into wellness centers. They collect 100% of rents. So that is pretty unique. Every other REIT, doesn't have full capacity at all times. And the fact that they have CPI rent adjustments built into their long-term leases with their tenants. So if the level of inflation is really high, the rents will go up to match that rate of inflation. So, Vici isn't really as affected by inflation as other REITs that don't have as much leverage on their tenants, because if one of Vici's tenants, like let's say on the Las Vegas Strip, they leave one of their casinos, then they can just get another casino company to come in and replace that tenant. And because there isn't a lot of real estate that specializes in casinos, especially on the Las Vegas Strip, they will command the price that they want, and they will not be dictated to by their tenants. Unlike an office REIT where, a lot of office REIT leases are ending soon. And when that happens, the tenant actually has the leverage because there's so many different offices available right now due to the low demand. So actually, it is a buyer's market, if you want to think of it that way, for any company looking for office space, if they're even looking into office space, because of the hybrid, work from home lifestyle that has sprung up in the last few years. So that's why I'm avoiding the office real estate sector, and I'm really, really bullish on Vici Properties going forward. People will always want to gamble, always want to have experiences, and this company is very well managed, and they only do acquisitions when it will provide value to the shareholder. So that's another thing I really like. They won't just purchase a property just for the heck of it. They want to grow the funds from operation for shareholders. So unless a deal provides immediate value to shareholders, they just won't do it. And I like that restraint. So very good management, and I love the business model. So let's get back to the portfolio. If you do like this type of content, please like the video and subscribe to the channel so you never miss one of my updates, as I do go over news that happens with my companies, buys and sells. So please do follow along so you never miss one of my updates. And feel free to follow me on Twitter because I also kind of share some buys, so you don't have to wait for my videos necessarily to be updated on what I'm doing, and I'll share, of course, any interesting news I find in the market as well. So let's get back to it. And Apple is in the media right now, so they have a little bit of a spotlight on them because there are a lot of headlines saying that China's banning iPhones, but that is kind of disingenuous because it's not receiving a countrywide ban, kind of like how Canada and the United States banned, Huawei phones and Huawei networking infrastructure in Canada and the US. So China is basically just banning iPhones from government positions, but, they're not targeting Apple. They have actually wanted to restrict everybody to using Chinese phones only. So this isn't really them targeting Apple necessarily. They don't want people using Samsungs either because those also aren't Chinese phones. So overall, it's a small part of their Chinese market. I think they'll actually be totally fine. And in fact, that little 5% sell-off that they had a couple days ago. It's like, I think it was 7, but it's mostly recovered. It's like half recovered from that. So it's dropped a little because of that. And they have their Apple event coming up in a few days where they're going to announce the first iPhone with a Type-C port. So that's going to be a very big deal because I know a lot of people have, Androids, and they would be willing to try the iPhone, but because, they have to buy a new cable, like the lightning cable, that was a barrier to entry. Now that's gone. So I really think Apple is going to have a lot of great sales with their iPhones coming up. The iPhone 15 might be their best seller of all time, might get a lot of people switching to Apple and then stuck in that ecosystem of just Apple goodies where you have to buy everything Apple for it to work well together. And with Aritzia, I purchased one more share going to 42 shares. I just think this one is really, really beaten up right now. They do have their earnings coming up soon. Lululemon did have quite good earnings recently, so I am hopeful that this would carry over into Aritzia. They are different businesses, but it's a similar idea where they have a strong brand and they sell, higher end luxury clothing. So the fact that Lululemon does have that demand does give a little bit of faith that Aritzia can do the same. So we'll see how that does coming up in their next earnings call. A lot of doubt in the stock right now, but I do think it can come back. It's just simply a matter of, people are pricing in a full recession, and the Aritzia management is also pretty conservative with their outlook. They're not saying that they're going to grow at, incredible rates in the near term. They also have a lot of investments this year to building a distribution network in Ontario to service, parts of Canada and also the United States, which is the real key of their expansion because over half of their revenues are from the United States right now. And if they dominate the United States and really, really grow into a strong established brand, then there's no telling how many times Aritzia could grow in terms of valuation and the market cap. And I also started a position in CNR. So I did have this in my portfolio closer to when I started my channel because I decided to purchase it when it was rumored that it was going to be buying Kansas City Southern for that acquisition. And it was actually trading in the sub 130 range. So I decided that I wanted to buy it because the only reason they were going down is because whenever a company purchases another company, it negatively impacts the stock price of the company purchasing the company and raises the stock price of the company being acquired. That makes sense because usually the company buying it has to pay a premium. So that means less money now. For of course, you're hoping that the value in the future will make up for that. But in the short term, it negatively impacts a company to have to buy another company. But CNR, as we know, did not actually end up buying Kansas City Southern. CP Railway did. So this one shot up to around this range, and I kind of flipped it for a profit. And after that, I think I bought some Apple, like one of my first Apple shares with the proceeds from that sale. But I have been wanting to get back into CNR for a while, even though they didn't win that deal. They do have quite a great business, and they have a very diverse loads that they have. They're known for growing their dividends. They're known for growing their revenue, their earnings per share at a nice pace. And it's just an industry that I don't really think will ever go away just due to how large Canada is. It's very expensive to transport things in Canada because we have a lot of wide open spaces that lead nowhere. The geography is very unique too. There's a lot of mountains where trucks are not really an effective way to ship things from Canada. And as inflation goes up, people are going to want to pay less to receive things. And as we know, rail is the cheapest way to travel and haul a large amount of things. So as long as the railways are going to be a cheaper option to ship things than trucking, I think it will always have its place in the Canadian economy because it ships so many things that we need. And I am looking forward to adding to this position because it's pretty fairly valued, I think. CP Rail, I think, is really overvalued at the moment, so that's the reason I went with CNR over CP, but I think CP is a great company as well. I wouldn't mind owning both, to be honest. If the valuations were similar, I probably would split between the two, but as of right now, I'm sticking with CNR. I also purchased 3 more shares of ENS, so with With this one, they did have announced a purchase of assets from Dominion Energy. They're going to pay for it with a combination of debt and a little bit of dilution. I think it's like 4.6% of shares outstanding. So a lot of investors are very scared. They're acquiring a lot of natural gas utilities, and according to Enbridge, it will increase their cash flows, diversify their business, and it'll be accretive to shareholders. While I understand diluting shareholders right now when Enbridge is basically at a 52-week low does seem kind of, foolish at the moment, I think that when you have an acquisition possibility in an industry where you can't really grow, you can't really lay down more pipelines, the existing infrastructure, this might be it, whatever exists. And going into utilities does give you a lot of stability with cash flows. So in the short term, it's kind of uncertain. People are scared because, when you issue shares in a dividend paying company, it kind of pushes the payout ratio higher, which means that the company is paying more of their profits out of pocket to shareholders. There's less to reinvest into the business. So we'll see how this turns out. If it does provide a lot of stability to the cash flows, I'm sure that they could buy back some of the stock that they issued. And over time, this would help with alleviating some of the concern around the safety of the dividend. But, Enbridge has not burned investors yet. And I think that they deserve, benefit of the doubt because they have not shown poor judgment and they have safeguarded the dividend for a very long period of time. Now, if they get the dividend, of course, I'm going to completely backtrack on what I'm saying here. And also people are not happy that they're acquiring debt. But if you go back to 2020, Berkshire Hathaway also acquired some natural gas utilities from Dominion Energy. So it seems like Dominion Energy is struggling and it's selling off assets and chunks of itself. So if Berkshire Hathaway sees the value in it, I can kind of see where Enbridge is coming from. Diversifying the business and increasing cash flows is a good thing long term. So we'll see what happens with ENS. It has dropped quite a bit. So I'm going to be adding to my ENS position and increasing my position in Enbridge because this seems like a pretty good buying opportunity. They don't really announce a lot of acquisitions, so this is going to be pretty interesting. And then with ETHY, I purchased 2 more shares going up to 76 shares. So what I do to buy this is I shake my phone every single day with Shakepay, and then I sell that free Bitcoin, and then I purchase this Ethereum ETF, which pays me a monthly dividend. So I can invest in cryptocurrency, but I can also get a dividend for it. It's very, very high risk. I would like to make a bit of cash on the side with this. So feel free to use my link in the description below. You can also sign up for WealthSimple. Right now, they're actually offering up to $12,000 if you sign up and deposit some money and until September 13th. And if you do so, you do support the channel. Then with Granite REIT, I also purchased 1 more share going up to 12. So this has recovered quite a bit. It was in the low 70s, and then, I see CNR just dipping, so I just took the opportunity to reinitiate the position. I think it's pretty attractively valued relative to the 2 options in Canada. I think that, this is the clear winner in terms of price to value of the business. CP, I calculated should be around in the 60s range for their shares, but they're nowhere near that. And CNR is pretty close to where I think it should be. But with Granite REIT, just industrial real estate all over the world, and I think that it's just a solid place to be for the long term. And the financials of this company are good, very strong balance sheet, globally diversified. Just there's a lot to like with this company overall. So pretty excited to add to it. If it drops again, definitely going to be adding to it. I wouldn't even mind adding to it at current prices, but there's a lot of opportunities in the market right now. So I kind of have to be selective and kind of go for the biggest opportunities that I see. And then with Intel, there's actually a lot of news surrounding Intel. So the sentiment around Intel has completely changed for the positive. So number one, they're going to be accelerating their fabrication plant in Arizona, and they do foresee that they are going to have the technological advantage with the smallest leading edge chips by 2024. So that is a huge, huge deal. If they actually do have the technological lead in the semiconductor space, not only are they going to make the best chips for themselves, they can also sell their services to other companies for their foundry business. So it's looking like Intel is turning around the story. Sadly, I didn't buy more shares before this turnaround, but I thought Intel would be beat up a lot longer than it has. That's why I haven't really been adding to it. We're going to see if the sentiment kind of shifts, if there's some kind of a delay or some kind of sell-off in the tech sector. I'll definitely be looking to re-add to the position, but it seems to be heading in the positive direction right now because people are seeing that Intel is really, the plan is being executed. It's actually being pushed forward a little bit because, they're building their factory faster than expected. So this is great news for Intel. And also, it's been found that their AI chips are beating NVIDIA's in certain AI-related tasks. So the fact that NVIDIA is getting all the credit for, being so far ahead in AI may not be true, actually, because if Intel is this close, with their first, couple of attempts, like this is their second Gaudi chip and it's beating the NVIDIA one at some things, we're going to see not only Intel, but a lot of companies are going into making AI chips. So NVIDIA has a lot of competition. This isn't like their core business of graphics cards for desktops because anybody can really come along and make an AI chip. So I really don't think NVIDIA is as safe and as sure thing as people think it is. So it'll be interesting to see where that goes. So Intel getting a lot of credit for AI chips, but also the expectation that they're going to take the technological lead in 2024 with their new chip factory. I also purchased one more share of Smart Centers. So pretty stable real estate investment trust, pays me every single month. And their biggest tenant is Walmart. So pretty stable company that you can rely on, and also a great way to incentivize other tenants to join a plaza, which is near a Walmart, because you're going to get a lot of foot traffic to those areas, and you can get some customers from the Walmart. If you are a specialty retail store that has products that Walmart just doesn't have, or some kind of service or bank or something, just something you can benefit from all that traffic. And then I did my monthly purchase of 4 shares of Telus, and any utility, any real estate, telecom, just basically the entire Canadian sector is not really doing very well right now because of high interest rates. So just can continue doing my buys of 4 shares of Telus each and every month, and I'll keep doing it until the end of the year, and then I'll probably still continue buying Telus into the new year, but maybe just not 4 shares a month, maybe like 1 or 2 shares here and there if the prices stay at these low levels, because it is a pretty good, solid dividend grower. They have a nice starting yield, and they do grow the dividend at a nice rate as well. And if you've watched the whole video, thank you so much, and please don't forget to like and subscribe if you enjoyed the video. For the dividends earned, I've earned $17.5493 since starting the portfolio. And we can see that my monthly average has increased from $96.03 to $98.13. So $2 away to reach my goal of hitting $100 per month in dividends. And we can see that if my portfolio were to work a 40-hour work week for me, it got a 2-cent an hour raise at work, so 57 cents an hour versus 55. So we can see the portfolio is growing with all my deposits and the dividends that I continue to reinvest into the portfolio. And with the recent dividends I've earned in September, I finally passed all of 2022, so we've already out-earned all of 2022, and we still have more dividends coming in September and the last 3 months of the year. Let me know in the comments below if you have any dividend goals you're trying to achieve as well, and have a great day, everybody.